Hello everyone. The topic for week 6 is cash flow statement. We will learn about the statement of cash flow, the different formats of the statements of cash flow, the preparation of the statement of cash flow, as well as analyzing the cash flow statement using common size and ratio analysis. The statement of cash flow provides information about the total cash received and total cash paid during an accounting period so that it accounts for the changes from the opening balance of cash at the beginning of the year to the end of the year. For example, here we have that the opening balance of cash is 490, while the closing balance of cash at the end of the year is 878. So the cash flow statement accounts for why there is an increase of net cash, that is 388 here in the case of Colgate-Palmolive. These changes are grouped into three categories which we will learn about later, that is operating activities, financing activities, and investing activities. If we look at the 3 year trend in cash, we see that the cash has increased in net by 323 million if we add up the net changes in cash over the 3 years. That is 45 million positive, 110 million negative, and 388 million positive in the year 2009, 2010, and 2011 respectively. The beginning balance at the start of 2009 is $555 million. And at the end of 2011, the closing balance is 878 million. This represents a 323 million increase in the cash for Colgate-Palmolive over this period. The cash flow statement then provides detailed account of the changes or factors that have led to the net increase or decrease in the opening balance of cash at the end of the year. Here we have the cash flow statement of Apple for the year 2010. There is a net increase of nearly 6 billion and the closing balance of cash is 11.26 billion for the year 2010. The net increase in cash of nearly $6 billion is accounted for by operating activities, investing activities, and financing activities. Operating activities have generated nearly $18.6 billion in cash. However, out of it, 13.85 billion have been consumed by investing activities as net. Financing activities have resulted in a net cash flow generation of $1.25 billion. The end result is there is a net increase of nearly $6 billion in cash, and we see that the closing balance of cash is $11.26 billion compared to the opening balance of cash, which was around $5.263 billion in the year 2010. Apple has invested nearly $58 billion in marketable securities, while it has received $24 billion from maturing marketable securities and $21.8 billion from the sale of marketable securities. These activities then explain the huge $14 billion cash outflow from investing activities. Cash activities are classified into three groups or categories on the statement of cash flows. These include operating activities, investing activities, and financing activities. Operating activities include the day-to-day activities of the company that are related to generating revenue, such as selling goods and services, and other activities that are not classified as investing or financing. These activities include cash sales as well as cash collection from customers. In addition, to generate revenue by selling goods or rendering services, companies have to buy supplies and then pay to the suppliers, or purchase inventory and then pay to the creditors. In addition, companies also have to pay their operating expenses such as salaries, wages, rent, taxes, etc. Investing activities include the purchase and sale of long-term assets and other investments. Other investments, for example, may include both short-term and long-term investment in debt and equity securities. These investments therefore exclude any investment in securities considered as cash equivalents that are very short term and highly liquid securities, and securities held for trading or dealing purposes. Securities that are considered cash equivalent or tradable securities are reported as operating activities. Financing activities, on the other hand, relate to securing or repaying capital. Capital includes common equity, preferred equity, and debt. Borrowing from creditors such as banks, or issuing bonds, or repaying the loan principal, or redeeming the bonds, issuing or repurchasing stock or preferred equity, and paying dividends are all examples of financing activities. If we look at the cash flow statement of Colgate, we see that operating activities have consistently contributed positive cash flows throughout the 3 years and are the main source of cash flows for Colgate. Despite that, in 2011, we see that the cash flow from operating activities has gone down, they are still positive and contribute significantly towards the overall cash flows of the company. We see that investing activities and financing activities are consistently consuming cash throughout the 3 years. This is consistent with a mature company like Colgate, where it has positive cash flows that are relatively stable over time. However, all of it is contributed to operating activities and where cash is consumed mostly by investing and financing activities. Contrary to this, a young or startup company would have most of its cash flow coming from financing activities that will be consumed or invested in expansion or growth. At the same time, the operating activities would mostly be negative or very low. Here we have the operating activities section of the cash flow statement for Colgate. Instead of focusing too much on individual reconciling item, we should focus on the overall relationship between net income and operating cash flows. Over the long term, for a mature company, the net income should be less than the operating cash flows. That is, the operating cash flows should exceed the net income over the long term. If a company has net income that is rising while at the same time the cash flows are falling, it can be a red flag. Such a pattern may be indicating potential problems such as problems in credit policy and the slowing collection of accounts receivable. However, it depends on the profile of the company. For young or startup companies, this may be a natural outcome in the early years of business. However, for mature companies, one should be concerned about such a pattern. In the case of Colgate, we see that the operating cash flow provided by operating activities is exceeding the net income in all the 3 years. We observe that the operating cash flows have declined in 2011 compared to 2010 and 2009. However, the management discussion and analysis explains that it is because of the increase in the voluntary benefit plan contribution in 2011. Here we have the investing activities section of the cash flow statement of Colgate, and we can see that the net cash provided by operating activities exceed the capital expenditure required in each year for Colgate. For example, in the year 2011, the net cash provided by operating activities is $2.896 billion. In the same year, the capital expenditure required is $537 million. We see that the net cash flow used in investing activities is increasing from 2009 to 2011. The management discussion and analysis explains that this increase is mainly attributed to the acquisition of Cenex business for $966 million. The sale of property and non-core product lines include the sale of laundry detergent business in Colombia for $215 million and the receipt of the first installment of $24 million from the sale of a Mexico City site. These details have been provided in the annual report. Here we have the financing activities section of the cash flow statement from Colgate. We see that the net cash flow used in financing activities in the year 2011 is $1.24 billion. which is considerably lower compared to 2010 and 2009, where it was more than double or nearly double the amount of 2011. There are two main reasons for this decline in the cash flow used by financing activities. First, the company had higher net proceeds from the issuance of debt in the year 2011. We can see that the company issued new bonds worth $5.84 billion. At the same time, the company only retired old debt worth $4.42 billion. Then the company also had lower amounts spent on stock repurchases in 2011 compared to 2010, where it spent more than $2 billion on stock repurchases compared to $1.8 billion in 2011. We can also see that dividend paid have increased steadily over 2009 to 2011, and this is quite sustainable given the company's net operating cash flow and the amount of capital expenditure required. So the company had funds available to pay dividends and increasing dividends over time. In week 4, we learned how to perform the common size analysis of income statement. For that, we expressed each line item in the income statement as a percentage of net revenue or sales. In week 5, we learned the common size analysis of a balance sheet, where we expressed every line item on the balance sheet as a percentage of total assets. There are two approaches to perform the common size cash flow statement analysis. First, we can express each line item on the cash flow statement as a percentage of net revenue. Second, we can express each line item of the cash inflow or outflow as a percentage of the total inflows or outflows of cash. Here in this example, each category of Colgate's cash flow statement is presented as a percentage of net revenues. Operating cash flows are consistently close to 20%, though in 2011 it is a bit lower. The net cash flow from investing activities in absolute terms is slightly higher in 2011 compared to the previous 2 years. However, this is explained by the Cenex acquisition. The net cash flow used in financing activities is lower in 2011 compared to 2010 and 2009 in absolute terms, and this is explained by the net proceeds from debt as well as the lower acquisition in 2011 compared to the previous 2 years. In summary, there is an increase of $323 million in cash over the 3 years from 2009 to 2011. Colgate has been consistently generating cash inflows from operating activities and using cash in investing and financing activities, which is quite typical of a mature company. The Colgate's operating cash flows have consistently exceeded net income every year in the last 3 years, which is a desirable profile quality for a mature company. In every year, Colgate has generated enough operating cash flows to cover its capital expenditure. Dividends paid have steadily increased over the last 3 years, and this has been due to the operating cash available that is sufficient enough to not only cover capital expenditure but to pay the dividends that are increasing over this period. Overall, Colgate's cash flow present a very positive profile of the company as a mature company. There are two acceptable formats for cash flow statements. However, in both the formats, the investing and financing activities remain the same. However, the changes only apply to how the companies report their operating activities. These formats are known as the direct method and the indirect method. Note that the amount of operating cash flow is identical under both the methods, that is the direct method and the indirect method of reporting operating cash flows results in the same amount of operating cash flow. The presentation, however, differs across the direct method and the indirect method for the operating activities. The Colgate's cash flow statement has been prepared using the indirect method, where the operating activities begin with the net income, and net income is actually linking the cash flow statement to the income statement. The net income is then adjusted for accrual accounting as well as other items, including non-cash transactions, to arrive at the net cash flow provided by operating activity. One of the main arguments for the indirect approach is that it shows the underlying reasons for the differences between net income and operating cash flows. Another argument is that indirect method mirrors the forecasting approach that begins by forecasting future income and then deriving cash flows by adjusting for changes in balance sheet accounts that occur because of the timing differences between accrual and cash accounting. In the direct method, specific cash inflows and outflows that result in reported cash flow from operating activities are shown. The direct method shows each cash inflow and cash outflow related to a company's cash receipts and disbursement. In other words, the direct method eliminates any impact of accruals and shows only cash received and cash paid. The primary argument in favor of the direct method is that it provides information on the specific sources of operating cash received and cash paid. This is in contrast to the indirect method, which only shows the net result of these receipts and payments. Just as information on the specific sources of revenues and expenses is more useful than knowing only the net result, that is net income, the analyst gets additional information from a direct format cash flow statement. The additional information is useful in understanding the historical performance and in predicting future operating cash flows. Though IFRS and US GAAP encourage the use of the direct method, both the direct and indirect method are permitted. The US GAAP encourages the use of the direct method, but it also requires that reporting entities present a reconciliation between net income and cash flow, which is equivalent to the indirect method. If the indirect method is chosen, no direct format disclosures are required. The majority of the companies reporting under the IFRS or the US GAAP present using the indirect method for operating cash flows. Here we have the operating activities section of the cash flow statement for Tech Data, which is prepared using the direct method as it does not start with net income. It is showing the sources and uses of operating cash, for example, cash received from customers, cash paid to vendors and employees, interest paid net, and income taxes paid. Remember that Tech Data is a US GAAP reporting company and that the US GAAP require interest paid to be presented in operating activities, while the IFRS allow it to be reported as a financing activity or an operating activity. Here we summarize the key differences for classification of cash flows under IFRS and the US GAAP. Most significantly, IFRS allow more flexibility in reporting different items such as interest paid or received as well as dividend paid or received in comparison to the US GAAP. For example, under IFRS, interest received can be classified as an operating or investing activity. However, the US GAAP only allows it to be classified as an operating activity. On the other hand, dividends paid can be classified under IFRS as an operating or financing activity, while the US GAAP only permits it to be classified as a financing activity. Similarly, the bank overdraft under the IFRS is considered as part of the cash equivalents. However, the US GAAP does not allow it to be included into cash and cash equivalents, and it is classified as a financing activity. Also note that under IFRS, taxes paid is generally an operating activity. However, a portion of the taxes paid can also be allocated to investing or financing activities. On the other hand, the US GAAP only allows taxes paid to be classified as an operating activity. Here we have the operating cash flows of Portugal Telecom, and we can see that the company here is presenting its operating cash flows using the direct method. We see that the operating cash flow do not start with net income. Also remember that whether the direct method is used or the indirect method is used, the investing and financing cash flows will remain the same. Here we have the investing cash flows of Portugal Telecom, and we see that it has reported interest and related income as well as dividends as part of the investing activities. These are income from fixed and equity investments, and under IFRS, Portugal Telecom is reporting them as part of investing activities. However, as discussed earlier, under US GAAP, these can only be reported as operating activities on the cash flow statement. If we look at the financing activities of Portugal Telecom, we note that interest and related expenses have been shown here as financing activity. We know that the US GAAP require that interest and related expenses should be classified as financing activity. However, the IFRS allows companies to report them either as operating or financing activity. Portugal Telecom reports under IFRS, and it has chosen here to report interest and related expenses as a financing activity in the financing activities section on the cash flow statement. Companies may also engage in investing and financing transactions that do not result in cash inflow or outflow. For example, if a company exchanges one non-monetary asset for another non-monetary asset, there is no cash changing hands. Similarly, no cash is involved when a company issues common stock either for dividends or in connection with conversion of a convertible bond or a convertible preferred stock. Because there is no cash involved in these transactions, such transactions are not included in the cash flow statement. However, because these transactions affect the company's capital or asset structure, any significant non-cash transaction are required to be disclosed either as a separate note or as a supplementary schedule to the cash flow statement.